In May 2026, Treasury Secretary Scott Bessent characterized the AI safety talks with China as a narrowly scoped exploratory first step. Public analysis of that statement implies a 30% probability of imminent regulation. Yet the order books tell a different story. Capital markets are pricing the probability of a signed AI executive order by July at 45%. This 15-point gap suggests capital is reading a drafted foundation that has already been laid, while the public remains focused on the stillness of diplomatic press conferences. Capital is measuring parallel agency timelines and specific enforcement actions that the press is ignoring. In this environment, the order book reflects a mechanical reality that official statements do not. Observers often misread executive power as a series of unpredictable political threats. In reality, it functions as a designed, mechanical system. Understanding this requires ignoring the political rhetoric and looking exclusively at the branch's structural mechanics. We must measure the mechanical inputs of the regulatory engine. For institutional investors, the goal is not to forecast political consensus, but to identify the specific parts of the machine currently in motion. The first force driving this machinery is macroeconomic pressure. The Bureau of Labor Statistics reported a 1.9% advance in import prices for April, driven by war-related logistics and fuel costs. This chart shows how that data feeds the Fed rate contracts. Capital has priced the probability of a June rate cut at just 22%, indicating that inflation has overflowed its theoretical bounds. This price pressure raises the political cost of any visible, market-rattling executive action. Because broad legislative action is too visible and potentially inflationary, the administration is routed toward hidden, fragmented executive mechanisms to achieve its AI control goals. The first hidden track is at the FTC, currently holding an overdue policy statement that classifies state-mandated bias mitigation as a deceptive trade practice. Simultaneously, the Commerce Department is evaluating burdensome state AI laws for litigation referral, while a separate proposal gives U.S. intelligence agencies a structural role evaluating frontier AI models. These three tracks, commerce, the FTC, and intelligence, are engineered to converge. They form a single regulatory pipeline designed to output a drafted executive order. This system is operating exactly as designed. It bypasses the need for congressional approval by utilizing existing agency timelines. The market divergence exists because the public expects the system to wait for consensus, while capital knows the pipeline is already operational. We can see this willingness to compress timelines in the recent $1.3 billion Medicaid deferral targeting California. The presiding federal judge noted that the size and timing of this action was historically unmatched. Prediction markets priced this enforcement action at 88% before it occurred. Capital read the move as a mechanical certainty rather than a contested political decision. This healthcare enforcement demonstrates the pattern. Executive officials interpret their administrative authority to compress timelines. It is the same structural mechanism being readied for AI governance. The mechanism driving this velocity is the doctrine of law as a variable. Traditional governance treats law as a boundary. Like an immovable stone, a judicial injunction can halt an action entirely, stalling the administration's executive orders. Law as a variable is different. It treats statutory limits and constitutional friction as optimization parameters, variables to be creatively navigated around for maximum speed. By treating the law as a tunable parameter, the executive branch bypasses the years-long legislative process, allowing a complex regulatory architecture to be assembled instantly. There are two potential paths. Path A assumes the executive order is already written, utilizing national security authority, waiting for a diplomatic trigger. Path B assumes the diplomatic stalling is real, relying solely on existing, slower agency dockets. If Path A triggers, the contracts for FTC and intelligence enforcement will instantly reprice upward. If Path B triggers, the market gap collapses. Capital positioning depends on identifying which path the administration is walking, making public press conferences irrelevant to the final outcome. The executive branch is operating a mathematical optimization function that cannot be voted on today. We must reduce this crisis to a single, observable metric. The watch signal is the AI EO 2026 contract threshold in the 7-day window following May 21st. If the contract breaks above 0.55, the hidden architecture is confirmed live. If it drops below 0.30, the executive timeline has faltered. Do not predict. Watch the May 21st threshold to know when the architecture